Thank you very much. Thanks very much for coming along and having a listen. So you've got a double dose of technical analysis, but the interesting thing about myself and my colleague David, who you've just listened to, is we both look at the markets in quite a different way. So we have different approaches to how we analyse the markets using price. So it's quite interesting that you've got me straight after him, and you'll get those different perspectives, hopefully. As Camille said, I've been in the markets for over 30 years. I spent 10 years as a broker on the futures floor in London, and so I wore a silly-coloured jacket and did hand signals to buy and sell financial futures. So that's my background. I'm from financial futures. I actually don't know much about the energy markets at all, but we'll discuss that on the next slide, I think. So enough about me. I originally started as a technical analyst writing a daily report for clients in the financial futures. I was then asked, can you apply the same principles and the same methodologies to the energy markets, to oil and gas and things like that? And I've successfully done that now for 15 years. And so I produce this is the sort of thing I produce every single day, and I'm just looking at price, and I'm looking at various things, candlestick charts, the moving averages, and it's widely read around Europe by energy traders. So, as David previously alluded to, as technical analysts, we're only looking at the price. There's actually three main tenets in technical analysis. Everything is in the price, which is kind of what David said, answering one of the gentleman's questions earlier. Everything is already in the price. But the other things we believe and we see is that market action is repetitive. So you see recurring patterns of behaviour in the market, and if you can spot those and you see one today or tomorrow, then you can make that assumption that may be, that can tell you something about where things may go in the coming days. And the other thing is that prices move in trends, and trends persist, and that's what I'll spend the first few slides looking at, the next few slides looking at with you. So what my clients get from me is 100% unaffected by any bias whatsoever. If I don't know, I'm not on one side or the other of the energy mix. My clients are a complete mixture of different types of trader and different time frames, and I don't know why markets go up and down, and I don't want to know. I'm quite happy not to know. And that's my financial futures background means that I have very little knowledge about the fundamental drivers in energy markets, and my clients are quite happy with that idea. They're quite happy with the idea that all they get from me is analysis of the price. And if they're happy with that assumption, number one, that everything's in the price, then my analysis is reasonably pure, you could argue. And so it was a chap called Charles Dow 100 years ago that came up with one of the very basic tenets of technical analysis, that prices move in trends and trends persist. Charles Dow used to write a letter every day called the Wall Street Letter, which later became the Wall Street Journal. He also set up a business called with his partner Edward Jones. So I don't know whether you can guess what they may have called that company. There was a third partner in the business called Charles Bergstresser. And I always feel a bit sorry for Charles, because I think maybe they said, look, Dow Jones is a nice short name, Dow Jones Bergstresser, too long, can't do it. Anyway, Charles Dow had spotted with markets that you could define trend in the markets, and there were trends that were prevalent in the markets. And an uptrend, a rising trend, is a series of higher highs and higher lows. And every time you make a higher high or a higher low, you create a support or a resistance level. You create that is the moment, the price where it changes, the balance of buyers and sellers changes. And so you can identify those price levels, and you can use them in analysing, is the trend, have we got a series of higher highs and higher lows? Yes, we have an uptrend. Have we got a series of higher highs and higher lows at this point? Yes, we are still in an uptrend. How about now? Is that an uptrend or a downtrend? I would say right now, looking at that chart, that's still an uptrend, because to turn from an uptrend to a downtrend, we need to start making lower highs and lower lows. That's the definition of a downtrend. Nice, simple stuff. So we have to break the previous support level in order to say we are now in a downtrending market and we should be looking lower. And as we look lower, we look back at previous price history. We look back as far as we can to the left-hand side of the chart to see, has the market been here before? Because when the market goes back, and this happens in most markets, and it's very, it's very reliable. When markets go back to old prices, old levels, it does generally have an effect. And it's interesting that David, in the previous talk, talked about German power and 45 euros. I've actually got 44.40 to 44.80 as a key area of support, because that was where we bottomed out at the start of the year in those particular markets. So we're very close to saying the same thing price-wise, and that's a crucial area of support in German power right now, and that's what I'm saying to my clients. So there's lots of things that technical analysts have at their disposal to identify when support or resistance levels are created. David showed you slides with Ichimoku, the cloud charts on there, and he also uses point and figure charts. I'm more of a candlesticks man, which is, again, like Ichimoku, is a Japanese style of looking at the markets. And I also look at trend lines, and I look at price gaps, and I use Fibonacci analysis a lot in my discovering where the support and resistance levels are, where the important price turning points could be, and what we need to be keeping an eye on, and therefore how we can structure trades, basically. And structure trades whether you are trading on a daily basis, intraday or daily or longer term. So saying that, let's look at power and gas markets this year and see what has been having a strong say. I do a lot of seminars and training for clients as well, and one of the things I talk about is price gaps. A price gap is when something opens either above yesterday's high, in which case yesterday's high instantly becomes a support level and a price level that the market is going to watch. Or conversely, if it opens below yesterday's low, in which case yesterday's low instantly becomes a resistance level, a price level that we'll watch if the market tries to rise. And I've added this chart to my training seminars now. This was UK gas at the start of this year, because it left price gaps above the market, just almost not on a daily basis, but there were a lot of very weak opens happening around that time. And all I said to my clients every time we saw one of these is, well, we can't even think about buying this unless we retake that gap. So stay bearish. This is going lower unless we can get above that gap from that we created with today's weaker open. And so actually I managed to say, looking at that chart, stay bearish below. I can't actually read the price levels now. It's just like stay bearish below 60, stay bearish below 59.70, stay bearish below 58.50, stay bearish below 57.20. It was almost, I was boring myself in the end with using these price gaps, but all of my clients were saying, wow, that really was effective, and that really worked well. And it was a very simple thing. And actually, if anybody does keep an eye on gas markets, and have had a look today we opened below yesterday's low, so we have a price gap. 15.45 in TTF is now a resistance level. If we can't get back above 15.45 today, it's going lower still. And looking at old highs and lows in TTF, in fact, there are some old lows from 2016. Down at 14.25 to 14.40. So there's a target, and where we are, that's their immediate target basically for TTF, and these things are pretty effective. I put these slides together last week, and that was what UK gas looked like last week. We'd actually and I think it was on Tuesday, and that shows that on the particular day I'd put this together, we'd had a green candlestick, the market was going up, and it at the time I put this together, we'd got above that what we call a downtrend line. But actually what happened there was, by the end of that day, we had dropped back and closed back below that line. And that was about as bearish price action as you can see. The buyers had an opportunity right at this moment to keep the market above that line, and maybe, there's some encouragement for their cause. But by the end of the day, we were back below the line, and sure enough, a week later, I'm talking to you, and we're making new lows. No big surprise there. And so one of the things I like to look at is candlestick analysis and look at particular patterns that can form mostly on the daily charts I look at. And I have a thing that I call the candlestick cheat sheet. And I see there's a couple of you getting your phones out to take a picture of this. Don't worry, you can have one. I've got one here. I've got a pile of them here. Look, there we go. Camille has got a whole pile of them, so you can all have one of these at the end. So one of the first patterns that we'll look at on here is called a hammer candlestick, and a hammer candlestick is a candlestick when the market is falling that has a long lower, what we call the long lower shadow, a long tail to it. And that suggests a day where the market is rejecting the downside and finding buyers. And actually that's what we'd seen a couple of days, we saw 2 weeks ago in UK gas. But as we now know, that line actually we failed at that line, or failed to stay above that line, and therefore we're making new lows. So on this occasion, those hammer candlesticks that we saw 2 weeks ago did not work because we didn't see any follow through. So they don't work all the time. And I can tell you, if they did work all the time, I definitely wouldn't be standing up here telling you about them, would I? Okay? I'd definitely be just sitting at home, or maybe sitting on a yacht in the Bahamas with a nice cigar in one hand and a bottle of champagne in the other, and just trading them every time they came along. So, yeah, okay, they don't work all the time. We also saw a couple of hammer candlesticks in coal last week, 2 weeks ago, and again, there was no follow through to the upside, and we are now back at those lows, making and retesting some really important support levels. And again, I saw that David's short-term, his outlook on coal, as discussed previously, was pretty bearish. I kind of agree with him, but I would say we have an important support area at 62 and another one at 59. The 59 level coming from my Fibonacci analysis. So I'm only going to get really bearish of coal if it breaks below 59. It's got a chance to recover before that. If we see some decent candlestick reversals, giving us an idea that the market may be changing before then. Again, I think I need my reading glasses. That's German power. Right, that's German power, and what we have seen there is we saw a hammer, again, sort of hammer 2 weeks ago, but we haven't seen any particular follow-through. So on this occasion, that particular pattern that we saw across a number of markets did not get the sufficient confirmation to say that a bottom was in. If we're talking about German power, we should talk about another candlestick pattern called the engulfing pattern, and there are two types of engulfing pattern, and it's a two candlestick pattern. And an engulfing pattern is effectively, a bullish engulfing pattern is effectively a market that's going down and posts another bearish day and then opens lower today, let's say, but then rallies very strongly over the course of today and closes strongly, closing above yesterday's open. So you'd have a candlestick with a real body that surrounds or engulfs the one before it. And engulfing patterns have been our friend in German power all year, basically. I've highlighted there the highs and lows over the course of this year in German power that have been defined by engulfing patterns. So that's been, that's the one I'm waiting for in power. We're still made new lows we're back to the lows from September, October in that one. But if I see a bullish engulfing pattern, then I will be getting more interested in the idea that possibly things are bottoming. And again, you can see from that chart the importance of 44.5 to 44.80, because that's those lows on the bottom left-hand side of the chart. But one other thing I look at, and it's been quite a friend in power this year, is the shape of the bell curve of volume, basically. So what we've got on the right-hand side of that chart, and it's a little bit unclear, it's not, we maybe needed to make it a bit darker for you, but we have the volume at price histogram. which says to us that most of the volume in German power, Cow 20, has gone through around 48 to 48.50 all year. That has been a very strong magnet for price. So we've moved down to 44, 45, 46, rallied back to 48.50, gone up to 51.52, come back down to 48.50, and it's a very, very balanced Gaussian looking curve. If this market was trending and didn't have a very strong idea of where value was, that would not look as nice looking and bell curve shaped as it does. So that again has all year encouraged me to consider that German power is stuck in. It's very much in this range. It's very happy in this range. It's very happy pivoting either side of 48.50. And so we should be looking for buying opportunities down at these sort of levels, and conversely selling opportunity. There may be sellers reappearing when this thing gets up to 51, 52, 53. So that's kind of a snapshot of the way I look at the markets. As far as support and resistance are concerned, there's some very general rules that you could make. Don't buy things that are just below. Don't buy something just below strong resistance. Wait for it to get through the resistance. If you want to sell, don't sell something into support. That it might just bounce from that support level, and then you've sold near the low. Look for where there are gaps between support and resistance levels that can say to you, well, and a lot of my clients, they're looking at the support and resistance levels that I post every day, and the bottom left-hand side is my interpretation of the support and resistance levels for certain markets. And interestingly, carbon emissions yesterday, the high and the low of the day were exactly to the tick, bang on levels that I'd identified as potential support or resistance. And so clients of mine look to trade at the levels rather than in the middle of the levels, and making the assumption that that says if we break below 25.15, we can go to 24.81. Okay, so don't trade at 25.00. Either, if you want to buy at 20, if it gets back above 25.15, or wait for it to get down to 24.81. That's the kind of concept we've got. So I cover the energy markets every day. Cover Brent crude and WTI. I look at the US, Dutch, and the UK gas. Also look at German power, coal, and carbon emissions. And please feel free. I'm going to hang around for an hour or two, probably at the bar. I think that sounds like a good idea. So after the next speaker's done, if you want to come and find me and say hello, please do. And in the meantime, if Camille can do the honours, maybe or just pass the parcel, maybe. So if you want to grab as many of these as you like, and then please do. And thank you very much for listening. And I hope it's been of